Hey everyone, how are you? I am Jorge Sanchez, manager, co-owner of Physician on Fire. So excited to talk to you guys. Um, what a great way to start! It's March, and we're getting ready to that horizon, that finish line called tax season. And today's webinar is called "Smart Tax Moves to Help You Keep More Next Year," which is very important. We've been working with Earned. They are definitely a one-stop shopping service, lots of services under one roof. We've been working with them for about a year and a half. We have a mobile app that we really worked to develop with them. I could call it your CFO in your pocket. So we'll give you a QR code at the end so you can download it and check it out. Um, and we're going to be doing Q&As as we go along, but at the end of the slideshow, we'll definitely be ready. Just ask any question. And again, doctors, thank you for being here. Let me introduce you to Brett Lamont. He is CPA and Senior Tax and Wealth Advisor over at Earned. Hey, Brett.
Thanks, Jorge. Well, I'm glad to be here. And it is tax season. We've got less than 3 weeks left to the deadline, so I'm definitely counting down for that. And I'm glad to be here with you all today. I was able to present in a prior Physicians on Fire webinar. So if we've got any repeat attendees, thank you for being here. Hopefully I can shed some light on some new topics for you, some new planning opportunities. And if you haven't, we really just want to dive into, some of the key mistakes that people are making on the tax side, on the planning side, and wealth management side of the opportunities you have to work through. So I have been with Earned for over 10 years, over a decade of experience here. I work with doctors. Our firm works with about 3,000 different doctors, and we are a member of the Academy of Dental CPAs. We work with a lot of dentists, a lot of physicians. We've seen it all. Our firm's been around for over 50 years. We've seen all the goods and the bads, very successful people retiring with, multi-millions of dollars. We've had people get to retirement without, much to show. And so we've learned a lot just by seeing all the different sides of people, whether it be practice owners, W-2 employees, associates, 1099 contractors, partnerships. We've got people with surgery centers, you name it, we've dealt with it. And so we'll jump right into this. Let me share my screen. All right. Before I get into the tax stuff, we want to just kind of reiterate the things that we're seeing. 53% of doctors feel burned out at some point during their career. And the number two reason is money, right? Whether you're saving enough, whether you're paying too much in taxes, just managing all the administrative side, things that come with taxes and filings and all of that. That's what's burning a lot of people out. The average doctor is in the 35% federal tax rate, right? And that's just federal taxes. Then you've got payroll taxes. Payroll taxes are another 7.65%. You've got your state taxes, right? There's states like California where the top rate is over 13%. So those taxes really add up. The stat that really stands out to me is this last one. 25% of doctors are behind on their savings, right? Behind, we're defining that as doctors that are retiring with less than $1 million in net worth. Isn't that sad? You all have such great earnings potentials in your careers and doing what you do, and none of you on this call should ever be in that situation, but that's a real stat. And so we want to make sure that, none of you fall into that category where you're not having enough to retire. So put this thought out there. Just imagine that if you could save $25,000 a year in taxes, what impact that can have on you if you were to take that savings and invest it. So if you were doing to save $25,000 per year in taxes, put it into an investment portfolio, get an 8% annualized return, what impact would that have on your life? Right? So after 10 years, that could compound into a $391,000 impact. After 20 years, that could compound into a $1.2 million impact. And after 30 years, you've compounded into a $3 million impact, right? And so people are always going to ask, well, Brett, can I really save $25,000 a year in tax? And you absolutely can, right? We've got those stats with the tax rates, and there's certainly enough wiggle room with the planning opportunities to work with to save that much. And so we're going to go through some of those items today and some of the misses that people have in terms of saving. You're not going to save $25,000 a year in tax if you are not proactive tax planning. So if you're the type of person who, gets to tax season, right? We're less than 3 weeks away from the deadline. If you haven't talked to your CPA for the last year and you're just now going to them and trying to wrap up your return, or maybe you're saying, hey, I need an extension, I don't even have my stuff together, right? You're probably not saving $25,000 a year in taxes. If you're proactively planning, right, and meeting with your CPA frequently, going through a checklist of items to work on through the year, doing a mid-year review, making sure you're paying in your quarterly estimates if you have those, having a year-end planning meeting, right? You're going to identify opportunities to work on. And so that's one thing that sets, just a tax preparer apart versus a good CPA is somebody that's going to sit down and plan with you. And we think that's extremely important, that you take a proactive planning approach to your taxes, to your wealth, and your administrative duties. So the tax strategy number 2, maximize employer-sponsored retirement plan contributions. I'm assuming that almost all of you have access to retirement plans at work. If you're self-employed, right, you also have these opportunities through your self-employment income. And so there's a 401k, there's 403b plans, there's profit sharing plans, there's cash balance plans. We're going to dive into those a little deeper here in a minute. But, mistake number 1 or number 2 that we're highlighting here is, there's a lot of people out there just not even maximizing those opportunities that you have already set in place and that you can take advantage of every day. Not only if your employer has a matching plan, right, then that's just an added benefit. But I get asked a lot, like, hey, Brett, should I maximize my retirement savings, or should I put my money elsewhere? Well, we are big advocates of maximizing this first, being your core part of your retirement plan strategy. Take advantage of the plans that you have through your work or through your self-employment income, because it can move the needle a lot, right? If you're looking at that column right there, $70,000, that's the max amount that you can put into a retirement plan if you're under 50, with the profit sharing portion, the employer portion, and the salary deferral portion, which is the 401k. That's going to move the needle for you for taxes. And that can all be tax deductible for you every year. These are the types of retirement plans. I like this chart because it just kind of breaks everything down in what you have available, right? You have IRAs. You can fund $7,000 a year into an IRA if you're less than 50. And if you're over 50, you get an extra $1,000. So any of you that are turning 50 this year in 2025, make sure that you take advantage of the catch-ups, right? On an IRA, it's an extra $1,000. And on a 401k, you get an extra increase as well for your catch up. So go change your deductions from your paychecks if you haven't already. If you're turning 50 this year, you get that extra catch up contribution. And there's inflation adjustments for these as well, right? So last year, the max 401k was $23,000. This year, it's $23,500. So go take advantage of those inflation adjustments. If you haven't already, make sure that you're on track to max out your salary deferral options that you have as well. For those of you self-employed, you do have other options. You do have SEP IRAs and simple IRAs. If you've got 1099 income, you can set up those types of plans as well. And then I have this big one on here. That huge slice in this pie chart is the cash balance plan. That allows you to fund up to $383,000 tax deferred into a retirement plan. And so it just gives you a lot more to move the needle, right? If you're a 1099 contractor, or you have a practice and you don't have a lot of employees, that could be a good option for you. The cash balance plan can sometimes work in a group practice, just depending on ages of staff and stuff. So if you've got the money in your budget to fund a much larger retirement plan contribution each year, have an analysis done on a cash balance plan and see if that would work or be a good fit for you and your setup. Tax mistake number 3 is failing to diversify across the different retirement plan vehicles that are available, right? So we've got 3 different buckets that we can work with in terms of investing. Right? You have a tax-free account. That's going to be your HSA, health savings account, or your Roth accounts. That grows tax-free. Your tax-deferred accounts are your 401k. That's traditional 401k. You're basically you put money in, you get a deduction up front, and it grows, and then you pay tax on that money in your retirement years. So you get all the deductions up front as you fund those plans, and then in your retirement years, after you're 59 and a half, or you don't have to start drawing from those plans until you're 73, but all of that income that you put into those plans will be taxed as ordinary income as you start taking the money out. And so the big mistake that we see here is people, especially doctors, just they go all in that tax deferred bucket. Like I've seen a lot of people come to us and they've done a great job saving. They might have a few $1 million saved up in their retirement plans, but it's all in tax deferred assets. And that's a problem, right? Because they're just kicking the can down the road and they're going to pay tax on that money, on that big nest egg, as ordinary income in their retirement years. And so we really want to utilize all 3 buckets. The taxable bucket is your brokerage accounts. You put post-tax dollars into those accounts and you don't get a tax write-off, and that money would grow, but it would give you long-term capital gain treatment or short-term capital gain treatment on the growth of those assets. You can pull from that money any time. You just have to pay the tax on the growth of that account. So I want to bring up a few things here. We're always looking for opportunities to get money into that tax-free bucket. And I'm talking about rolling money into Roth. Right? When you do a Roth conversion, or if you roll money from your tax deferred accounts into a Roth account, it's taxable. You'll pay tax on that conversion at your ordinary income rates. And so we're always looking when you're meeting with your CPA, if you know something's going to be unique to this year that's going to drive your income down to a low tax bracket, that is the opportunity to do a Roth conversion. So a lot of you on this webinar have probably heard about the real estate tax strategies, cost segregation studies. we'll see if we have time to discuss some of those. That's another webinar in and of itself, the tax planning opportunities with real estate. But I have, clients every year that are buying real estate, right? And they're looking for opportunities for a cost segregation study, right? I had a physician last year who did a cost segregation study, and we were able to bring his income down $600,000 from what it would have been without that cost segregation study on his real estate. And so if you have an opportunity like that where you can really drive your income down with a large item, maybe it's equipment or a build out or a business purchase, we want to be able to look and see if you dropped your tax brackets and if we can convert money into a Roth at a lower rate than you're typically in. That's a perfect example of how to get money into these tax-free accounts and optimize your situation and have huge impacts for you over the long term. Another one I get asked a lot on is the Mega Backdoor Roth. I don't know if you guys have heard of that one. The Mega Backdoor Roth is where you fund your 401k as a Roth contribution, right? Why would you do that? Well, you might do that if you're just starting out, maybe you're just getting out of school, maybe you have a partial year worth of work and you're in an artificially low tax bracket because of the situation you're in that year. You might want to fund a Roth 401k or 403b instead of a tax deferred 401k. It gets money into the Roth, right, where you don't get a deduction for it. But then in addition to that, you can fund an additional $46,500 in non-deductible contributions to the plan in addition to the 401k. And that would go into the plan as a non-deductible contribution. And then you would roll that money over to a Roth. So again, we're not advising physicians to do those on an annual basis. That's not a good way to handle those mega backdoor Roths. But I get to ask that question a lot, like, hey, Brett, should I do a mega backdoor Roth? Well, we look for opportunities for our clients when they may be in a lower tax bracket year than a normal year.
And Brett, what I guess you have to know your own tax bracket, like what threshold you're at that would put you into another one, right?
Yeah, I always want to know where we're at with every person we work with. Where are you at in the brackets and how much wiggle room do you have in your bracket? So I remember one time I had a doctor who was very interested in building generational wealth. Like that was like their highest priority when they came to me. And they really wanted to get money into Roth. And so what we did is we did an analysis that looked out, 20 years in the future. And we kind of estimated how much wiggle room they had to the 35% tax bracket. So every year when we meet, we project out their income. And if there's any wiggle room in that 32% bracket or lower, we fill up that bracket with Roth conversions. And so we will only do Roth conversions up to the top of the 32% bracket. If it's over that, we don't want to pay that tax over that because that's how we built their plan. And so you want to do something similar. Maybe for you, it's the 24% bracket. Maybe it's 32, maybe it's 35. It just kind of depends on what your future earnings potential is going to be and where we think your rates will land based on the current law.
So what I'm hearing you say is that, let's say I'm a partner in a hospitalist group, right? And we didn't make that much money that year. And now I have a reduced income stream. That's not enough. You gotta drop into a bracket to be able to trigger these events, right? You have to change the bracket. It's not the fact that you didn't make enough money. You have to move to a new bracket for it to make it worthwhile.
That's right.
Okay. All right. Okay, good.
And it's something that sorry, just putting this back here. It's something that can be done at any bracket. You can convert. You can convert at any bracket, right? You can convert to Roth at the highest bracket if you wanted, but it doesn't typically make sense, right? And a lot of people when they retire, let's say you retire when you're 60 and you don't have to start drawing from your tax deferred assets until you're 73. You might have a 13-year period of time where you can be in a pretty low bracket until your required minimum distributions kick in from your retirement plans, and we may want to fill up some of those lower brackets with some Roth conversions. It's very typical. So bracket targeting is very important. Jorge, is that sharing okay?
Yeah, it looks good.
Okay. Let's go back to that slide that I just skipped over. Here we go. 1099 income is important. I think most of the people I've talked to from the Physicians on Fire group, most do have some way to have some extra 1099 income. Not everybody does, but we typically can build strategies to offset a huge portion of that 1099 income. Not always, but we're looking for ways to offset as much 1099 income as we possibly can. When you're just a W-2 employee, you really don't have a lot of ways to reduce taxes. So if you're on this call and your situation is you have a W-2 and it's $450,000 worth of W-2 earnings, and that's all you've got. Maybe you own a house and have some mortgage interest, some real estate taxes, some interest and dividend income. There's not a lot I can do to help you save taxes unless we can claim you as a real estate professional or have you buy some short-term vacation rental properties, or invest in more tax-efficient ways. Right? There's no way that I can directly offset your W-2 wages unless we're doing one of those strategies that I just mentioned. And so we really want to look for opportunities that are viable. And hopefully in this group, there's discussion on how people are generating 1099 income on the side. If it's an option for you, absolutely take it and then look for ways to offset that income, whether it be your vehicle deductions or your CE or your dues and subscriptions, your Spotify, your Apple, your phone, internet, home office, right? There's lots of things we can do to offset 1099 income. There's not a lot I can do for W-2 income offsets. And so we do like to explore opportunities for every physician we work with in terms of 1099 options. The first question I get asked when we start seeing a lot of 1099 income is, should I incorporate? Right? That's naturally the first question is, I'm going to get a 1099. They're asking me if I have a corporation. And a lot of the attorneys out there will jump straight to incorporation, right? They want to set up that S Corp. And I typically push the brakes on that a little bit because it really depends on how much you're earning, right? If you're only going to have 50 grand of 1099 income and your W-2 is 400 grand, it probably doesn't make sense to incorporate, right? We can set you up as a sole proprietor, Schedule C on your personal tax return. We can still write off all those things that I mentioned, all of your deductions. We can write a lot of that income off. Incorporating makes sense if you have a decent amount of 1099 income, because when you are an S corporation, you have to pay yourself payroll. You have to put yourself on payroll of your S corporation and give yourself a W-2 from your corporation. And that amount that you have to pay in payroll has to be reasonable. So the payroll portion of your earnings is subject to self-employment tax, but whatever's left after you run your payroll is not subject to self-employment tax. And so typically, if we've got enough 1099 income to work with, yes, incorporating does save you taxes because you only have to pay the payroll taxes on the portion of income that's going through to you as payroll. The rest you don't have to pay that SC tax on. And so that's one of the big benefits. S corporations are also going to have big benefits in high tax states like California or New York. In California, it's a big one. I think all my S corps take this. It's called the pass-through entity tax. That's where you can elect to pay your state taxes, your personal state taxes, related to the profits of your S corp as a business expense. So if you don't have a corporation, you've got to pay all of your state taxes on all of your profit as a personal expense, and you don't get a write-off.
Yeah.
But as an S corporation owner, you can make an election to pay those taxes, the same taxes, now convert that into a business write-off, and that will save you a really good chunk of money.
Any benefits to being an LLC?
So an LLC is when you register your entity with the state, and the LLC you'll have the option to be taxed as an S corporation, or you can have an option to just be a disregarded entity. A single member LLC can just be filed on your personal tax return, similar to a sole proprietorship. So there's no, like, the LLC will give you that extra layer of liability protection on your 1099 income. But in terms, like, if you just elect to be treated as a sole proprietor LLC, like a single member LLC, and tax on your personal tax return, there's not going to be, a big difference in what your tax looks like just by having that LLC. So if you do have an LLC, you want to look, like, does it make sense for me to file as an S corporation? That's what we're more interested in exploring there. If you're an LLC, should you file as a single member LLC, or should you file that as an S corporation?
Someone asked, what's the minimum 1099 income you can recommend for forming an S corp?
Yeah, I mean, it depends. There are some weird scenarios, right? Like, when I say weird scenarios, let's say you're a pediatric, you're a physician, you're making 300,000. Let's say you're making $300,000 and you have a non-working spouse, and you filing jointly. Well, in that case, we might not want to incorporate and have the entire thing just go to your personal tax return. And the reason is because there's a deduction called the qualified business income deduction. And that one is going to give you a deduction equal to 20% of all of your income, right? So if you have $300,000 times 20%, it's a $60,000 deduction. And when you incorporate that's partially going to go away. So that's like one of the unique situations. Typically, if your household income, if you're married, is over $450,000, if your household income being married is over $450,000, and we'll incorporate anytime somebody's 1099 income is exceeding about $50,000. Hopefully, and if you're single, then cut that all in half.
Got it. So, okay. So I guess the next question for me is, if you have, like, I'm a internal medicine trained hospitalist. So I did W-2s and I did 1099s. So what would be a ratio? Like, what would be the ratio of the W-2 to 1099 income? Because I had a choice. They basically, companies gave me a choice. Like, hey, we could write you as put you in a salaried and W-2, or
yeah,
I had the choice of being 1099. It's a good spot to be in, but just what is your thoughts on that?
Yeah, on that one, it's not defined by the IRS code on how much you would have to pay yourself. So I'm going to back up, Jorge, a little bit. You're saying if you have this 1099 income and it's flowing to an S corp, what should the ratio be, and how much you pay yourself as salary? right? Versus what you take as profit draws, S corp distributions, right? That's the question?
Yeah.
And so it's not defined. Like all the IRS says on that topic is it has to be reasonable. And so we usually want to stretch that and push it to the lowest end of the range possible for reasonable salary. So we have as much left over in profit to take as S corp distributions as we possibly can. And so in terms of a ratio, you might be looking anywhere from, 40 to 60% of total income taking as a salary versus profit draw. But we certainly want to analyze that and make sure that it would be reasonable. If an IRS agent were to ever look at that in an audit.
Got it.
Yeah. Don't pay your entire income out as salary. That would be a mistake. A lot of times what I do is a lot of times for our single owner S corporations who have 1099 income, similar to your situation, Jorge. If it's just somebody that wants to max out their retirement plan options, we'll build that reasonable salary off of that, right? So you've got to pay yourself $186,000 to max out your retirement plan, right? Because the retirement plan option, if we go back to those slides, remember there was a column that said you could fund up to $70,000 worth of retirement plan contributions. Well, that's only if you have $186,000 in salary. For every dollar less than $186,000, it's going to reduce what you can put away to those retirement plans. Because the employer portion is based on 25% of what your W-2 says. And so, if you only pay yourself a $50,000 W-2, right, and take 25% of that, then you would only be able to fund $12,500 into that retirement plan as profit sharing. So the retirement plans certainly go into that equation.
Got it.
So we've talked a lot about that. Hopefully, if you have a situation where you have specific questions about your situation, put some notes in the chat. We can always follow up with you later, after the tax deadline. Now, strategy number 5. This one is in here because a lot of people are just thinking, how can I save taxes now? How can I save taxes now? And they're just looking at the deductions, all those things that I mentioned about S corporation, deductions, write-offs, real estate purchases, depreciation. That's all going to be great. But what about your overall portfolio? You can save a lot in taxes by how you structure your investments in your retirement plan. And a lot of doctors on this call are investing in taxable brokerage accounts. They're doing a great job putting money away. And we'll look at the statements, and all of the money that you're putting away is in mutual funds or ETFs or index funds, which is totally fine as a way to initially get money diversified and be low cost and get you exposure to the overall market. Once your accounts start exceeding 50,000, 100,000, right? That's not always the best strategy for investing. And the reason is because if you have all of your money in your brokerage accounts locked up in these mutual funds, it doesn't give you a lot of planning ability to do things like tax loss harvesting or optimizing your charitable giving. Right. And so most people have heard of tax loss harvesting. It's very hard to do when your money is in mutual funds. So one thing that sets Earned apart from a lot of other people out there is we really spend a lot of time and effort building out models for custom indexing strategies that allow us to invest in a more tax efficient way. And what a custom index is it's essentially, a portfolio of individual stock holdings. So instead of logging into your brokerage account and seeing, the S&P 500 fund, you log in and you'll literally see 400 different, stock holdings that's essentially making up or representing the S&P 500 in individual stocks. So we build portfolios that track those indexes that, follow these popular index funds. And they're built in a way to essentially mirror what the market's going to do. But now you've got all of your positions in individual stock holdings, and now we can cherry pick the losers, right? So if we go back to 2024, what a great year in the market that was, right? We had great returns on the market overall, but there were still 75 companies in the S&P 500 that had more than a 15% drawdown at some point in the year. So what we do with these custom index portfolios is we will cherry pick those companies when they do have those drawdowns and capture those losses in the portfolio. So you get to the end of the year and your portfolio last year may have been up 24%, while we were able to loss harvest those companies that did have those drawdowns at some point during the year. That's a huge strategy that everyone should be implementing on this call, because if you tax loss harvest, you can capture a $3,000 loss to offset ordinary income, W-2 income, business income. You can loss harvest to offset $3,000 a year. And what you don't use, we call it banking that loss, which will roll forward indefinitely until you use those losses up. And so if you have, real estate that you want to liquidate down the road, or if you have a business that you want to sell down the road, a practice, or maybe you have ownership in a surgery center that you're going to sell someday. All of those items are long-term capital gain events that you're going to have to pay long-term capital gain tax on. And the only way you can offset long-term capital gain income is with capital loss income. You can't write off cars and depreciation and, cell phone and all that. You can't offset like capital gain income with those other write-offs. Those write-offs only offset your ordinary income. And so whatever you don't use in loss harvest, it will be carried forward until you have a capital gain event that you can now, use as a tax asset to save money on taxes. So a lot of people aren't handling that correctly, and it really adds up. If you think about it, like year over year of this accumulating really can have some substantial impacts over your career. The backdoor Roth, I think everyone should be doing this. This is a no-brainer to me, because it's $7,000 that you can contribute into an IRA. I'm assuming everyone on this call makes too much money to contribute directly to a Roth IRA. And so there's a backdoor Roth, which is a workaround to be able to get money into your Roth IRA. And the way you do it is you put money into a traditional IRA, you put your $7,000 in. That has to be funded by April 15th. So if you haven't funded your IRA for 2024 yet, you still have about 3 weeks to do so. Put your $7,000 into your IRA. Once those funds settle, you can convert it to a Roth IRA. And then it's going to grow tax-free for the rest of your life. So just doing this alone every single year, right? If you go back to that 30-year period of time, you could grow $1 million in tax-free income over the course of a 30-year period of time, if you just do this and you stay dedicated to funding that every year. So a couple mistakes here on this one is the failure to fund it for a spouse, right? Like I have a lot of clients who have a non-working spouse, and a lot of people don't know that the spouse can fund this, right? You can only fund an IRA if you have earned income. So a lot of people just assume they can't do it, that a non-working spouse can't do this. Well, they can. There's a spousal election that allows you to fund for your spouse even if they don't have any income. Another big mistake that we see with these backdoor Roths is people will have like prior 401ks that they rolled to Roth or to an IRA, or they have a lot of money sitting in an IRA account. And when you do the backdoor Roth, the whole purpose is to get money into these things tax free without triggering tax on that conversion. You have money sitting in IRA accounts that are out there, it will trigger tax on your backdoor Roth conversion. So we always want to look for opportunities to clear old IRA accounts out to 401ks. Because if you have that money in a 401k account, it won't trigger tax on that Roth conversion. So that's super important. Look and see if you have any other IRAs, if you want to do this, if you're not doing it. Or maybe you are and you've been triggering tax on your backdoor Roth conversions this whole time because you have IRA balances. Clear those to your qualified plans. Get it out of the IRAs. This applies to simple IRAs. This applies to SEP IRAs. Get all that money over to 403B or 401k accounts, and then you can optimize your backdoor Roth conversions without triggering tax on those. And then the next strategy here is asset location. When I time and time again, I look at people's balances, and people traditionally say, okay, I want to be in a 70-30 portfolio or a 60-40 portfolio or an 80-20, and they just have that allocation across all of their accounts. Roth, taxable 401ks. Right? It's super important to utilize the tax advantages of these different buckets. So this is a graph of your most efficient holdings in your account all the way down to your least tax efficient, right? So you can see down at the very bottom, it says taxable bonds. Well, the yields on a taxable bond, that's all taxed as ordinary income, right? And so you don't really want to have taxable bonds sitting in a taxable account because that's all going to be ordinary income to you. If you're going to hold any bonds that are taxable, you want to be holding those in either a tax deferred account or a Roth account, somewhere where we can convert that ordinary dividend income into tax-free growth, and just make that more tax efficient. So same goes with the REITs. Where are your REITs being held? Are they in your taxable account, or are you putting those in your tax deferred account? Right. And so we always will do an analysis with everyone we talk to. How are you holding your money? We want to look at every single type of account and make sure that the more efficient assets are in accounts like your taxable accounts. We just work through the list and make sure we're optimizing that asset location. That can have huge impacts over time and how much tax you're going to pay on the growth and the money in your portfolio. And we're about out of time. Optimize withdrawals. This is speaking to how you take money out of your retirement accounts. So the traditional way to draw money, like if you just go talk to an old-time advisor, they're going to say, when you get to retirement, first draw from your taxable accounts, and then draw from your 401ks, and then draw from your Roth accounts. That's not always the case, right? There's a lot of people that are just doing that because they heard that that's the best way to do it. Really, the best way to handle your withdrawals in your retirement years is to bracket target. We want to know what your brackets are going to look like through your retirement years. Because if you just go with this standard approach of saving your Roth money till the very end, that could be great. But at the same time, if you did that and you depleted all of these accounts, right, that Roth money is going to, like, a portion of that wouldn't have been taxed anyway, because your first portion of your earnings is going to be at a low rate, right? And so we really want to look at your rates in your retirement years and build a custom withdrawal strategy that optimizes your tax on your withdrawals from all of your different types of accounts. That's super important to bracket target on those as well. We don't have time to talk about others, but I do put this up here just so you can see maybe some of the other big ones that we do have opportunities to plan around. And real estate isn't, I don't have a lot about real estate on here. There's a lot of different tax savings strategies. I mean, we could talk for hours about the different planning opportunities that could present themselves over your careers. If you have any questions about any of these, a lot of them apply to self-employed people. Reach out, and we're happy to provide more insight on any of these other planning opportunities that you'll come across over your careers. Again, just reiterating, these things have such a huge impact, right? We're talking just implementing these strategies. If you're having that impact every year over year, and investing the tax savings that come from optimizing these items, it could easily be a $3 million or more swing over a 30-year period of time if we're looking at it in a compounding situation. Huge impact. And that's why it's so important. That's why we're hitting this group so hard, because we just can't stress this enough and how important it is. So what we want to invite you all to do is download the Earned for Physicians on Fire app. There's the QR code. You can scan it. You can use this for budgeting, for tracking your goals, for tracking your net worth, for monitoring your subscription. So it's got a lot of stuff on there. There's some content in there as well. Jorge, anything else you want to say on the app? And
no, the app is cool. Just download it and check it out. It's like, I call it a CFO in your pocket. We also get access to the Physician on Fire content, so you could actually read the articles while you're in there. The other thing is, you've joined this webinar. If you're late, you're going to be getting an email with a link so you can see the webinar in case you got called away to see a patient or something. You're going to get an email. Check. If you don't see it, it should maybe check your spam folder. But Brett, you want to answer some quick questions that we got? We got a lot of questions here. Let me just shoot a couple at you.
Okay, sure.
Any advice for tax planning for someone investing in cryptocurrency?
Yeah, crypto is unique because you get away from the wash sale rules, right? If you're investing in stocks, there's a wash sale rule with anything that's registered with the SEC. And so with crypto, you don't have the wash sale limitation. The wash sale is that if you sell a holding at a loss, you can't buy back that same holding for 30 days, right? So if you had some Tesla stock and you sold it at a loss, let's say a week ago when Tesla was really down, you wouldn't be able to buy that Tesla share back for 30 days. So you've got to sit on the sidelines for a while, and then you can buy it back after that. But the stock can move very quickly over 30 days. So, that's one of the limitations with stock. With crypto, that doesn't apply. So loss harvesting strategies, right, can really be optimized with crypto and how you're managing that. The other thing, I've talked to so many people with crypto, and they're like day trading, and then they have such a hard time tracking down their cost basis. We see it all the time where people buy and sell crypto on like a daily basis, and then they get to tax time, and it's like, their form is saying they have $100,000 gain, and it's like, well, we know that's not true, because you have cost basis. And so just making sure that you're tracking your cost basis on everything. We've had some people where it's like it's just been such a nightmare to find their cost basis on their crypto transactions that they just have to estimate or maybe pay more tax than they needed to because they can't find documentation for their basis.
Great. I have Dr. Joseph Piacentine. I've been told my backdoor Roths may be disallowed as I had an existing IRA, non-Roth. Is this an issue?
So that's what I was talking about when you can do the backdoor Roth. You can do the backdoor Roth even if you have $1 million in IRA balances. And so what I'm saying is, let's say you've got a doctor who's got $1 million in IRA accounts, traditional IRA, SEP IRA, simple IRAs, doesn't matter, over here, and then you want to fund, you want to do the $7,000 a year and convert it to Roth. That's the backdoor Roth. Well, you will have to pay tax on that $7,000 backdoor Roth due to the fact that you've got $1 million sitting over here in an IRA. Maybe it's 100,000, maybe it's 50,000. Having anything more than $0 in IRA balances outside of your backdoor Roth will trigger tax on that conversion. And so it doesn't disallow the backdoor Roth in and of itself. It just makes it taxable. So to create an optimized tax-free backdoor Roth, we need to do something with this IRA balance. And that's what I'm saying. Let's clear it out to a 401k, a 403b. Maybe if you have 1099 income, we could set up a solo 401k under your 1099 income and roll it all into a solo 401k plan. There's better options than just paying tax on that or saying I'm not a good candidate for the backdoor Roth.
Got it. Do a lot of your clients use the strategy of having their partners become a real estate professional?
We look for that. It doesn't fit for everybody, right? And so really the people that applies and works the best for is your working physician with a non-working spouse, right? Because if you want to be a real estate professional and get those depreciation write-offs, you've got to spend 750 hours in real estate activity to be a real estate professional, and I should say, and on top of that, over 1/2 of your personal services needs to be in real estate activity, right? So if you're working a full-time job, it's pretty impossible to get over 1/2 of your activity in real estate activity when you're busting 40 plus hours a week as a physician. So yeah, the non-working spouse helps optimize that. The other way around it is your short-term rental properties, right? They don't have that 750-hour requirement. A self-rental also does not have those 750-hour requirements. So I had a physician who just bought a commercial real estate property that he's renting to his S Corp. And since it's a self-rental, we can get around those hurdles of the hour requirements that come with real estate professional status.
Can you add to employer retirement account and separate trade, TRAD, IRA?
Can you separate trade? You're saying trading on that employer plan?
Can you add to employer retirement account and separate TRAD, IRA? I don't know what that is. And separate something IRA.
Yeah, I think the question, I could be wrong. Clarify this in the comments, but I think
no.
Can you do it in like a separately managed IRA account?
Traditional IRA is what the person's saying.
Traditional IRA. Yeah, I think how I'm understanding that question is can you take that employer money and move it over to self-directed IRA? The answer is yes. You do have those options. If you're doing the backdoor Roth strategy, right? Getting money into an IRA does not help the backdoor Roth conversion. So I think we have to look at it as global. Like what's the overall strategy? What are all the pieces that we're trying to accomplish here? And if the backdoor Roth is part of your core strategy, we may not want to do that. There may be better options there to handle that.
The last question is from Gina Moreno John. I am nearing retirement. Any last minute tax strategies into and through retirement?
So near into and through retirement. The first one I would say is let's review your Roth conversion opportunities, if any, right? So if I have a doctor who's going to retire, like I want to know if we have some artificially lower tax rate years before we have to start drawing out from retirement plan money. And so build up that cash reserve, build up that brokerage account, have some money to live on when you first enter retirement. Because if you do that, you can live on that cash, you can live on that brokerage account for a little while and just live on that for a few years. And that way we can convert money into Roth accounts and potentially have some really good impact there. Social Security, right? Do your Social Security analysis, right? Full retirement is 65. Typically for every year you defer Social Security benefits, you get an extra, I believe it's 8% worth of benefit per year. So as long as you're going to live for an extra 11 years, as long as you live 11 years past that time of when you're going to start taking Social Security, it would be more beneficial to defer that benefit as well.
You know, the way I look at it is, you know, you're going up the mountain and then descending down the mountain, right? Accumulation, decumulation. A lot of these strategies depend on what part you're in, right? So if you're in the descent, your strategies have to be totally different than the accumulation. One of the things I like about Earned is that you provide one-stop shopping that gives the physicians a chance to you know, your CPA consults with your accountant, which consults with your financial advisor, which are traditionally different siloed conversations, and which doesn't happen with Earned. So that's one of the big pluses for y'all to look at and consider. The other value is that your majority of your clients are physicians. Is that right, Brett?
That's correct. Yeah,
So
a lot of dentists and physicians. And so we only will take on a client if it's like someone's kid is a non-physician and they work in tech. Maybe we allow someone's immediate family to come on board, but we're very adamant about that because, like I said at the beginning, we've seen everything that you know the typical physician is going to deal with. We've had you know, everything from buy-ins and partners and, like I said, surgery centers or associates. Like we have all of that exposure and a great network that is critical for when we need to tap into that knowledge of just dealing with all these situations that you guys are seeing.
Yeah. So you guys have checked into smart tax moves to help you keep more money next year. I hope we gave you some great advice that you can consider. The big walkaways is talk to your tax advisor and your CPA ASAP. Don't leave it for the last minute. And of course, check our articles on just any questions that you have on tax. We've been working with Earn for over a year. We're going to be having more webinars with them. Check your email. You're going to get an email, I think, in the next, Brett, is it today or in the next day, a day or two, with the link with the webinar so you guys can review this. And of course, we're available. So we'll be seeing you again. Any last comments, Brett?
No, thanks for having me, and we'll be in touch if you got specific things related to your situation that we didn't touch. Let us know. Let Jorge know. Shoot me an email, and we're happy to dive into your situations as they come up.
Yeah. So again, thank you very much. Check out the Earned mobile app that Physician on Fire. We have a heavy hand in developing. We had a lot of say in that. It's a great app. Again, I call it the CFO in your pocket. There's also access to content there, and you'll see the QR code in a little bit in there. So thanks again. You all have a good day. Thank you for stopping by.
Thanks, everyone.
Take care.